Hello and welcome to episode 234 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leaks. Damien, how are you doing?
I'm good, but I do feel like we have to start this week's episode with an apology because...
I know what's coming.
Yeah, on Monday, we said last week we were going to do our Monday chat and we would be on Facebook between 12:30 and 1:30, but... we weren't. So if you turned up on Facebook looking for a post to comment on and talk to Andy and I, then unfortunately we weren't there. And there was a good reason, because one of the Money to the Masses crew was taken ill. So we ended up having to go to hospital almost en masse. So apologies for that. We will do it this week, won't we, Andy? We're going to be...
Yeah, pending emergencies.
Pending emergencies, assuming everybody's health stays intact. It wasn't me this time, by the way. It wasn't me with my health. But we will be online the usual time, which will be
12:30 to 1:30 on Monday. We'll be there.
Yeah, we'll be there. We'll put a post up and you just start commenting and talking about anything. Even if you want to talk about Tottenham, I don't mind. And us probably having lost our first game of the season, because the football season is back. And we won't go on about that. But
actually, the football season is back. And by the time this podcast comes out, our teams will have played. So... what a great win for Watford.
That's optimism for you.
Good. So what have we got coming up on this week's show?
Right, we got 3 pieces. An investment piece, which is about backtesting portfolios. Now, when you build a portfolio, there are times when it pays to have a look at how it might perform in the recent past. So if you want to make some changes to a portfolio, it can be a good idea to look at the portfolio, the new one, and see how it would have performed in key situations. I'll explain more about that because it was particularly relevant this week as I reviewed my £50,000 portfolio, which I run live on 80/20 Investor. The other piece is about pension fraud, and in particular 5 mind tricks that scammers use, fraudsters use to try and con you out of your pension wealth. And the final piece, which will be the one we'll start on this week, is to do with taxation, and in particular for freelancers. Now, anybody out there who's a freelancer, there's a change coming to the way that you will be possibly taxed. And we want to quickly talk about that today because it's something that's coming next year, so 2020, but you need to be mindful of it. And if you are an employer, or you're a company, I should say, that uses freelancers, then it may also be something that will impact you.
Good stuff. So you mentioned we're going to start with this sort of freelancer taxation thing, a change that's coming in next year. What is it? What's happening?
So I know we've got a lot of people who are freelancers listen to this podcast. We've done odd bits in the past, but what happens is if you're a freelancer, you are not employed by the person who obviously you do work for. So they are a client of yours. So you may be somebody who is a freelancer that might do a particular job. It could be writing. It could be doing anything. Now, there are rules that are out there that are called IR35 that are in place so the taxman, HMRC, can tackle disguised employment. And by that, I mean that there will be people out there who will, to all intents and purposes, will be employed. They will be effectively acting like an employee, but they can use something called like a private limited company. So they can use a limited company or something called a PSC, which is a personal service company, and get paid via that. So what they do is they make out they own a company, which is effectively just them, and then they get paid by their client, which is the person who would in normal circumstances be the employer, will pay them through that. It will usually be gross, and then they are free to take that money and do what they wish with it in terms of being paid. So normally it means they will start paying themselves in the form of dividends. They'll use other tools and tricks that are open to people out there who run limited companies and the self-employed. So they will use it as a way to basically avoid paying tax. It's not what the rules are there for. So there'll be some really high profile cases where this has happened, where people who are on telly, for example, who have been caught out, and if you go in the press you can find them, I'm not going to name them, who have set up companies where effectively they are a company and then they get paid by their employer, which is one of the main media companies out there, and it isn't technically their employer because they claim it's a client and they get paid through the company, and then they can basically take a lot of tax. The reason why people do it is because from their point of view, so if you were somebody who was a freelancer, by being paid through a limited company or one of these personal service companies, what it means is the money you get paid for the work that you do, you get 20% corporation tax. Now, for some people, that could actually be a benefit because it could be a lower tax than they would normally pay. So they get 20% corporation tax on profits, but they can also claim business costs against the money that they make. And so it can end up meaning they reduce their tax bill. They also can avoid paying full national insurance, and they therefore can manage the income that they earn, so their actual basic salary, to keep it low and then pay themselves in dividends. Now, there's been a benefit for doing that in recent years. That benefit has changed, actually. The sort of positive aspect of that has changed because the dividend tax-free allowance has been reduced. So in years gone by, there wasn't a big advantage over doing that rather than being employed through the company like normal. Then there was an advantage. That's been reduced a lot. So it's actually made people probably less likely to do it. But there are lots of people still doing it. From the company, the sort of who would have been the employer in that scenario, who ends up being the client, they actually avoid paying national insurance on the money they pay. They don't have to pay maternity pay, sick pay, holiday pay, and they also don't have to pay pensions. So it's kind of a win-win scenario for them. So that's why it's happened.
And also an added advantage to those companies, if they're looking to sell, there's less people on the books, less expenditure and things like that. So they look more attractive to buyers.
Yeah, so you can see why people have done it. It's not in the spirit of taxation, and you can argue the ethics over doing. That's why people have been called out. Now, there are rules out there called IR35. If you're a freelancer, you'll probably be well aware of it, and it's a means of testing whether you are an employee or you actually are providing a service rather than being employed. And the rules, if you go and search the rules, I'm not going to go through them here, but they are largely things like you have, if you truly are a freelancer, you don't, for example, have somebody, you don't have to do work that the person gives you. The employer, who would be the employer, so the client in this scenario, doesn't have to give you work. You also, as a freelancer, you could substitute somebody else in to do the work. So you can see that's very different to being employed. But if, for example, you're set up, despite having a limited company and you're trying to play the freelancer route, if all those things really you're just mirroring an employee, you are technically classed as employed. So that's what HMRC are after. Now, the reason I'm bringing all this up is because in 2020 next year, they're changing the rules, and the rules are being changed so that the company, so what would be the client, or if you think about it in another way, that would be ultimately the employer, that company is the entity that has to decide whether the freelancer's status is correct and accurate. At the moment, it's the freelancer themselves. It's the individual who says, look, I'm a freelancer. I'm set up through this company. This is correct. This is how you pay me. So going forward, it's going to be the company that has to decide. And in doing so, it means that they will decide whether they pay that person gross for the service, or they actually say, no, I think you're classed as an employee, so what we're going to do is pay you net of tax and NI. So there are going to be a whole bunch of people, and there's been numbers crunched, it's going to run into the millions in terms of money, that there's going to be a lot of people out there, freelancers, are going to suddenly find their wages or their earnings drop, and their estimates of as much as 9,000 per freelancer who are operating in this way, I mean, you have to be clear. This isn't for people who are generally freelancers, who freelance for lots of different companies doing whatever they do. This is for the people who are trying to use the rules out there, manipulate them, use them in the wrong way to try and pay less tax. They're going to get caught out. They could be faced up to $9,000 less earnings in a year. They reckon it could hit some people by about 25% of their earnings. So the message of this piece is, if you are a freelancer, you should be aware of the IR35 rules anyway. Refresh yourself over them to make sure you're not falling foul of them and you generally are a freelancer and the way you've structured your company, for example, is correct. If you are somebody out there who is using the rules in not the way they're intended, then your days will be numbered. But for obviously a company, if you use contractors and freelancers, then you're going to obviously be aware of these rule changes, because it could impact you in having to make decisions about whether somebody should be classed as an employee and be paying NI. Now, the good news is that there are going to be some small company exemptions, and small company exemptions, companies are quite big that are exempt. So the word on the street at the moment is that they're going to be looking at companies with turnover of over sort of 10 million, more than 5 million on the balance sheet, more than 50 employees. They're the sort of companies that are going to be impacted under these changes of these rules. If you're a very small company, then it's unlikely to impact you so much. But do keep an eye on the rules if you are a freelancer, or if you employ freelancers, or use freelancers, I should say, along the way.
Good. I think that's something that's been coming for a while. And do you know what? There's always been a bit of a grey line here. I think it helps just to, some people are going to benefit, some people are going to be annoyed by it, but at least they're shoring up the rules and people know where they stand going forward.
Yeah, well, apparently 2/3 of freelancers are unaware of the rules. They're unaware of the changes to the rules and they don't know how they will impact them. So it is one of those things I've been seeing coming along, but we've got to bring it up for people.
There's talk also that the freelancers have essentially been railroaded by their employers into this situation, and they never wanted to be in this situation in the first place. So it's kind of those guys that I feel sorry for. They were kind of like pushed, and now they're in a position where they're at a crossroads.
Yeah, and also some of the people I do think about who are impacted by these rules about being freelance. Imagine women who've had a career break because they've had children, they come back. I've known lots of people who end up freelancing for the company, the very company they used to be employed by, because they decided to leave and have a break. They sometimes, I do get the sense that they would perhaps go back and be employed if they could, but then they're on the freelance setup. And maybe this will get some clarification that some people will hopefully be employed, and for some companies to look at how they are using freelancers. But on the flip side, it is also a positive, because for some people, they do want to be a freelance lifestyle, but it does, that same group that I just mentioned there, they have to be careful, because if it feels like they are effectively just being freelance for their old employer and they're effectively employed again but on a freelance basis, then if it's a significant company that they're working for on a freelance basis, then they need to be careful. So it's just an FYI, just keep an eye on the rules and make sure you don't fall foul of them, because you don't want to be fined. Okay,
so on to investing then and backtesting your portfolio. Damien, you've been working hard crunching some numbers over the past week for our 80-20 investors, and you've got some insight here.
Yeah, what happened is I looked at my portfolio. So I tend to review my portfolio every month. That's the £50,000 I invest live on the site. So I tell people what I buy, when I sell, and there's no hiding. And the portfolio is doing really well, which obviously I'm very pleased about. And what I do is I tend to look at it every month. Whether I make a change to a portfolio every month, I don't tend to do that. I tend to make tweaks. Sometimes I don't do anything. So this month was a good example. I didn't change anything on my portfolio. I kept it the same. And the reason I did is because of the volatility we've seen in markets. Donald Trump has decided to have a trade war tantrum. He started to have a pop at the Chinese. He's going to impose new tariffs. They've responded in kind by reducing their currency. And so what we've had is a mass volatility spike, and the markets have sold off in terms of equities. Bond markets have rallied. So we're getting some amazing moves at the moment. We had the worst day, for example, of the whole of 2019 in equity markets. But on the flip side, we had some of the best days for bond markets. But this volatility makes it hard to make changes to a portfolio, because the market could move against you. It could move for you, but while you're out of the market, as a fund switch is going through, then you could be caught out. Of course, if you use ETFs or you invest in shares or investment trusts, you don't have quite that delay. But that's something for another day. Now, what happened is when I was looking at my portfolio last month, I was conscious when making the changes. I follow a process on 80-20 Investor. It's got a momentum at its heart, and I still bear in mind what I'm changing. And I like to look at how it might perform when I'm trying to build an all-round portfolio. So one of the things I did last month, I took a lot of time looking at how the new portfolio would have performed during May. Now, May was an interesting month because that was the last time we had a Trump tantrum over the trade war. So he kicked off about the trade war again, and then we had a big sell-off. So I looked at that and thought, well, do you know what? If I'm making a portfolio and I'm using the process, and we've always got that potential for Trump to behave again in that way because the trade war hadn't been resolved, then how would my portfolio have held up? So the choices I made were mindful of that. So I backtested. I actually charted the portfolio, looked at the individual funds and the composition and thought, well, how would it have fared? Now, 80/20 investor members will know that we have a stress test tool. Now, it's a tool which looks at various different scenarios over time in the past. So we've had tech sell-offs, we've had an equity market sell-off because China actually devalued their currency back in 2015. So we've had various different scenarios. And what I've done is built a tool that can take a portfolio and quickly test it to see how it performed, how it held up during those scenarios. So stress test it. So this backtesting, stress testing is a useful thing to do. So I did it in June, looked at what happened in May. Now, it's good because when the period is very close, so it happened very recently, fund managers are unlikely to have changed their portfolio composition. So you can pretty much be assured if you get a repeat of what happened in May, as in another Trump tantrum, you are going to likely get the similar result based upon how those funds performed during that month. Now, in this review, I actually increased my equity exposure from 40% to 60%. So I started to sort of open up the old shoulders a little bit and started to take on a little bit more risk.
Is that a big step in the grand scheme of things for someone who's not really into investing?
It is a fair step actually, because it's gone from 40 was one of the lowest I've ever had. 60 seems to be about an average that I have over the years I've been doing this. So it's a bit above average, but it's around about the average. So to go from like a 20% leap is quite a step. But because I was backtesting, I was very mindful that the funds that I was choosing, how they performed during that equity wobble we had, and the one that was based around Trump. So I picked those funds. They were largely had defensive qualities in them. Some of them invested in defensive sectors. Some of them were very bond focused. If you want to see the portfolio, you can do that. Take out a free trial on 80/20 Investor. If you just go to the site, moneytothemasses.com, you can find a link to it. And in doing so, I was comfortable. I thought, look, do you know what? If we have a repeat of that, then this portfolio would fare far better than basically its peer group. And despite the 20% increase in equities, it wouldn't have fared much worse than the portfolio that had 40% equity exposure. Fast forward to August so far, and we've had an actual repeat of May. So if you'd watched this week's midweek market, you would have heard me say that August feels very much like May. And that's because we've had a repeat with Trump in his tantrum over trade. The response from China and markets have behaved in a similar way, an almost identical way. So what happened is my portfolio, or my construction, my back testing, was therefore truly tested in the real world. And so far, I say so far, touching wood, that things have performed as I hoped they would. So they've held up. So despite that sell-off, I was still in profit. It's not to say that I won't be down if the market continues to fall, but compared to its peer group and other managers, then my portfolio is doing really well. I mean, there's not many that are performing better than me if you look at the mixed shares sector with like 40 to 85% equity exposure. And bear in mind, I've only got about 60% equity exposure. So the message is, if you are looking to make a change to a portfolio, it doesn't hurt to back test, to look at some scenarios, particularly downward scenarios. If you're worried about capital preservation, markets are at all-time highs. I know we did a piece about the likelihood of pullbacks. I think it was last week, but with markets looking quite stretched, we've still got trade war tensions, we've still got a poor backdrop of economics. There was always the chance that markets could pull back, particularly with Trump and his likelihood to throw a wobbler. Then it's prudent just to see how they would perform, and it might be able to might influence your decision. So by back testing, I was able to preserve capital, but capture the upside that I wanted to. So how could you do that yourself? Your platform might enable you to build a portfolio and make changes so you can see how it would have performed. Very unlikely, to be honest with you. Most platforms don't allow anything too complicated. They just show you what your fund is worth. If you go to moneymarketing.co.uk/fund-charting-2, then I spent a lot of time trying to find this tool because it used to live somewhere else, and I think they must have bought that service. This particular tool allows you to pick a fund or ETF, and you can pull up a chart and compare it to other funds over any given time frame. So very simply, what you could do is you could get a fund or your portfolio, look at each fund. You'd probably have to do it fund by fund. You won't be able to do it all in one go. And you could see how that fund performed over, let's say you'd done what I did, looked at May. You could have seen how that performed versus its peer group, versus other funds that you were likely to choose, from that same sector, for example, and seen how it would have performed, because although history doesn't repeat, it often rhymes. And then you could have done that for each of the funds and built a portfolio that could have had a bit of more downside protection. Of course, you're hoping for a repeat of the same event, and events aren't ever quite the same. No two events are. But it's a good way, it's a good experiment to try and benchmark a portfolio, just see how it performs during certain periods of time. Another good one is if you go back to December when the market really got scared after the initial sell-off in October. That's a good benchmark or stress test for if markets collapse in like fear, completely capitulate. And the October sell-off is a good one if we get a form of tightening from the Federal Reserve. So what you want to do, look for periods in the past that were certain scenarios that you may be tightening of the Fed by the Fed. It could have been trade wars. It could be the Europe collapse. It could be Brexit. And I've talked about it a little bit on the midweek markets. Go back and look at Brexit. So the Brexit referendum 2016, if you look at around the June referendum, you could use that, what I've just said, and you can see how different assets and funds performed during that time. Now, of course, it's 3 years on, so you can't guarantee the fund will perform in the same way because the fund manager may have taken steps to change the portfolio. And to be honest, they probably have after 3 years. But it will give you some indication of how things might perform. So there we go. It's stress testing and back testing. And before I move on, Andy, is the one thing I would say is I talked about benchmarking the other week, and that same tool I've just talked about, you could use that in the benchmarking.
Good. So I will put a link to the money marketing tool in the notes on this podcast. But you know what, Damien? As much as that is a great tip and a great tool and a great idea, you can save yourselves all of that bother by just signing up to 80/20, and Damien will do all of the hard work for you, do all the analysis, all of the commentary. Obviously, he'll be doing it on his funds, but hey, why not follow his funds because they're doing well?
That was a good plug there, Andy. It was. I mean, I try and just talk about free stuff, but you've done a very good plug. Yeah, you go and look at 80/20 Investor.
And then he'll do all the hard work for you. Right, we're going to be talking about pensions next, and someone has been looking into the psychological side of scams relating to pensions.
Yeah, now, the way scammers and fraudsters work, and let's not just say scammers and fraudsters, salesmen too, they use mind games to be able to con you out of your money, to be able to actually get you to buy stuff, maybe legitimately, but they would do it in a very underhand way. And it's to do with psychology, it's to do with how we work as humans. Now, there was a various pieces I've seen in the press this week about a psychologist who was talking about some tricks that these fraudsters use. She came up with 5 of them, which I'll rattle through. But one thing I would say to people, if you want some weekend reading, do go look at a book called Influence, The Psychology of Persuasion by somebody called Robert, I think it's Cialdini, I think it is. We did a podcast previously on this book. It was on the same premise about how salesmen and people can persuade you because of your human nature. There's loads of good tips. It provides a lot more than the 5 that they provide in these various articles I've seen, and far better ones. I'm going to add in 1 or 2 actually, but the ones that they pulled out were the foot in the door technique. So somebody would come and try to subtly manipulate you by getting you to agree to something very small at first and then gradually gain your trust. So they use an example of a telephone call or an invite for like a callback or something like that. So you build trust. In the book that I read, one of the good examples was the old salesman technique, the old Hoover salesman. So in the days gone by, what they would do is they would rock up and leave a Hoover in your house for a week, and then you would use the Hoover and then they'd come back and then you would have to say you didn't want it. So by basically that foot in the door technique, they've given you something and they've already got their foot in the door, then you're more likely to comply.
Hang on a minute, Damien. You said about the Hoover technique, where they leave the Hoover. That's basically what's happened in this. I'm drinking some water here. That's exactly what they did with the water machine in the corner of the office.
That was exactly what they did. So just so Andy's talking about, they come in, give you a water machine, they're going to give you free water for a couple of weeks, come back to see if you want it. And when they did it, I explained to Justin that's what they were doing. But coincidentally, we were just about to go and get a water cooler for the office because obviously you guys were all coming to work for us and we were expanding. So we needed one, but it was just coincidence, but we laughed about it. You're right, Andy. So, and they've done it in the whole building. So the water cooler people are legends at it. They're still using that technique, but they use it on pension scams. They're not necessarily leaving you water coolers, but they might be
giving you access to stuff or free advice or a tool or something to help you commit.
Yeah, or even something as simple as a phone call. Now, another one is apparently social similarity. They try and gain rapport by saying things like us, people like us. They try and use phrases like, oh, don't worry, I would feel exactly the same way as the one that's quoted in here. Who did this article? It's on MSN Money.
It's a lady called Honey.
Have you just made that up?
No, that's her name.
Oh, right. Well,
the psychologist.
Oh, right. I thought the person who wrote it. But it's all rhyming, very strange. Yeah, so they'll get you to feel that you are one. So you're the same like. So therefore you feel, as a human, you're not likely to turn around to say to somebody, actually, well, we're not alike. Scarcity is a famous one. They tell you you've got a limited time offer to do something. So therefore they get you to try and buy an investment before it goes. Otherwise you'll miss the deal. They'll use something called the halo effect, which is basically jargon or some form of letters after their name or whatever it is. They try and use complicated language or anything that makes them look very legitimate but very almost professional and aloof, and people tend to bow down and feel inferior. But often a lot of that is just a sham. So actually, rather than go on to the one of others that they've got, which I don't think is as good, there's another one that came from the book I mentioned at the beginning, which is about consistency. Now, as human beings, we have a trait that we need to be consistent, and it's because if you think about if we lived in the woods, in the caves, as a social group to work, you need everybody in it to do what they say they're going to do. Otherwise, it would collapse. See, we're very successful because if we went off into the woods and we broke our legs and fell over, then somebody would come and look for us because they knew we were going to be there, etc. So it's all about working together, and that's why it's built into us and people can exploit it. So, for example, you can get somebody to agree to something or say a statement that they don't agree with, but as humans, our brains are programmed to be consistent, so we would eventually start to believe it. So that's that power of positive thinking. When people start having positive thoughts, it's that our brain will start being consistent. So another example is I'm a Tottenham Hotspur fan. I'll never change clubs because my psyche won't allow me.
Even when they're rubbish.
Even when they don't sign anybody or even when they're rubbish. And so there's a whole host of things like that. Political parties, views about anything. And so that's why people won't change. So people who are con men, salesmen know that. And so they want to get you to say something or agree with something so they know you'll be consistent. And they used it in prisoner war camps many years ago. They used it to start sending back propaganda to the prisoners' country by sitting there saying on film that their captives were wonderful, even if they weren't, because in the end, it started to have an impact. It started feeding through to the prisoners and then eventually back home naturally. So be aware of that. People who get you to agree to any sort of statements about what you think or wouldn't you agree, that's a classic one. If somebody would say a statement and say, wouldn't you agree? And of course, you're likely to say yes. And then once you agree to it, then you're unlikely to turn around and say the opposite. So be aware. There's lots of mind games. Read the book. I think it's a brilliant book. If you read that, you'll find out a lot more mind games that you'll see in life and you'll just start spotting them. And if you can spot them, you're less likely to be a victim of them. But the other thing, I might do another piece later if people want to, and like another podcast about how this is in advertising. It appears in advertising a hell of a lot.
Yeah, and that book again is Influence, the Psychology of Persuasion, and we think that's by Robert Cialdini. Cialdini. If you Google the book, it's a very famous book. It'll come up on Amazon. Good, and we're done. So if you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. Check us out on Instagram. Do head over to Facebook on Monday between 12:30 and 1:30. Damien and I will be there answering your questions to whatever questions you have, whether it's this podcast, other podcasts, or just something about the world.
Just life in general.
Yeah, we're done.
We're done, so until next week.
Until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.